Welcome back to We Get Macro, where we're going to continue to talk about the financial system. Okay, so now we talked a little about the stock market and bond market and what the financial system is. So financial system, financial markets. Now let's understand a little bit more about financial intermediaries. Okay, now there's a lot more financial intermediaries than the ones I'm going to talk about here, such as pension funds, insurance companies. But here, for the purpose of the semester and due to time, in terms of how much content we have to cover, I'm gonna prioritize banks here, okay? Especially because those are the ones we tend to deal with the most and tend to not know how they function, okay? So let's get started. So first, I'm gonna go ahead and ask you to pause right after I provide this discussion, and please take some notes and try to think through why this is the case. Because the reason why we're doing all this is to understand how this can impact our lives. And it's important to know, right? If they're so much in our economy and participating so much and impacting it so much, why do we need them, right? It's important to think about that. So take a second and try to think this through. Okay, so hopefully you had some time and put down some good notes and try to compare them with what we do now, with what I talk about now. But as usual, we can discuss them in our virtual classes as well. Okay, so big summary here is that in a nutshell, financial intermediaries can help savers pretty much indirectly provide funds to borrowers, right? Not only that, they have more functions than that, right? They also provide different types of payment methods to its clients, ATM services, so the ability to be able to withdraw your money from different types of locations besides the bank branch. So a bank branch is an office of a bank, right? A bank can have several branches. So for example, BB&T, right, which now just merged with SunTrust. So BB&T has several locations across the country, right? And since that's the case, it's still BB&T, but different branches of BB&T, okay? But we're gonna get into the functions more later on, but a really, really important one is the ability of a bank to solve the problem of incomplete information in the market, okay? So this includes problems with both moral hazard and adverse selection. So these are problems that we would face if you try to lend money to one another, try to answer that question, right? So why do financial intermediaries exist and why do they play such an important role in our society? Because it's really hard to lend money to one another because of the costs associated with it that maybe we don't think about anymore because we have financial intermediaries that do that, right? But think about the risks of, for example, if I own a small business and I go to you, since now banks don't exist in this world that we're imagining here, and say, hey, I want to borrow, and you say, no problem. I think you have a good business idea. Here it is. And as soon as I get that money, I say whatever, I'm gonna go and gamble it, right? That's me coming into this transaction without good faith, right? I have bad intentions with what I'm gonna do with the money once I get it, right? So that's a problem, right? So that's the moral hazard problem that banks can help because they can monitor those individuals more closely, especially because individuals tend to have checking accounts and other types of accounts with them, which allows them sometimes to have an idea about their spending habits and things like that, right? There's also the adverse selection problem. The adverse selection causes the problem of screening. So if there's a problem, it's hard to monitor borrowers. It's really hard to screen them too, right? How would you, for example, our whole class of 200 students, right? If everybody was applying to get a loan with me, how would I decide which one is best, right? That's really hard too. And it would be easier for you guys to hide information from me because it would be hard for me to verify that information about each one's income, what they want to do in the future, their ability to pay me back, right? So a bank has an advantage on this too. So it solves both problem with screening and with monitor individuals in this market for loanable funds. Okay, so then how do they make money? For in class, we do this in the Think, Pair, and Share and make this on the board, but let's dive into it. And we can do this in the virtual classes as I've been mentioning. So what is the functions of the bank and how they can make money? Okay, so that's kind of unwrap those together, even though the slides would be separate. Okay, the first myth I want to break is that if you've been watching movies thinking that, hey, let's go rob a bank because all the money's there. I'm sure they have a good amount of money there, but it's not all that money. Okay, banks do hold some of the money that we deposit, but they use large share of those deposits to make loans with it. Okay, and not only that, in the world that we live today, there's so much technology and so many different types of payment methods, and everything is computerized, that the majority of the money in monetary funds in the world are electronic, right? So they're not even held in terms of physical currency anymore. And imagine if we still had to do every transaction through cash. Imagine, would online shopping even exist? It would be really, really hard to say if it would be that popular, because it'd be very slow. You'd have to send money through an envelope to the mail, right? And as you can see, there's a lot faster, more efficient ways to do that that banks allow us, helps us get to that point, right? So the functions of banks, as we mentioned, in terms of the depositor side, and I already talked about how they make a little bit of money in this side. They take deposits from savers, right? We deposit money in our checking, savings accounts, and the banks give us some type of return. So that's part of their expenses, right? That's the interest rate they get on your savings account. Checking account, most of them don't even give us interest rates. So you're pretty much giving the money, letting the money use your bank for loans for free, right? No, for free in terms of monetary assets, right? But because you do gain some type of security from them keeping your money, which is important for us, because how many of us check how our bank is doing on a daily basis, right? Do you know if it's performing better or worse than last month? We have no idea, right? And that's something to think about. They have all your money there. But as I mentioned, banks also provide different types of payment methods. So through a checking account, which you can leave your money there, right? And works as a medium of exchange. So we talk about doing money in banking, different types of money. But through these accounts, we can access our funds, right? Those deposit and checking account funds. And then with the debit card, which is a payment method, we can then use that debit card to access our money and then pay our transactions, right? So banks also gain a share when you swipe your cards, right? There's this really, really small share of the transaction that they're earning in terms of revenue as well, right? What else? Banks then use those deposits to make loans, as I mentioned, and they charge an interest on those loans. So, right, so the spread, the difference between what they pay us, the depositors, and what they charge the borrowers, that's one way that they make money as well. Okay. And as you know, the loans market really facilitate buying goods and services, especially such as cars, houses, right? Big purchases that we usually don't tend to have that much money to drop in all at once, right? They also offer investment services, right? So some banks offer investment services related to help firms issuing their IPO when they want to go to the stock market, their initial public offering. They help value companies through mergers and acquisitions. They offer investment opportunities and to manage your portfolio, right? And they also do research by generating new payment methods, new types of technology, and things like that. Okay, and as I said, we kind of already mentioned some of them. So through the interest rate spread between the paid by borrower and received by depositors, they make money through fees, so overdraft fees. Whenever you don't follow restrictions on your savings account, so you have a limit of 6 restrictions per month on a savings account. If you go more than that, you have to pay a fee, right? So you really got to be aware about what are the rules of the contracts that you're engaged in with your bank in terms of loans and leaving your money there. Okay. More than that, they also sell loans. So as I mentioned in class, in 2007, banks used to approve mortgage loans and then sell them off, right? So this means literally they make the initial money on the transaction because there's some fees they have to pay when you start a loan, and then they sell that off to somebody else so they don't have to deal with the borrower anymore. Now the borrower responsibility of the buyer of that loan. Okay. And as we mentioned, they have investment services as well. Besides the one that I mentioned, one that some of you guys already asked me about in class, and I wanted to point out, is a mutual fund. So mutual fund, it's let's say the investment bank owns a mutual fund, which is a type of investment tools for us, right? It is restricted in terms of it has some restrictions of minimum amounts they have to deposit to be able to be part of the mutual fund, right? To invest in mutual fund. But it has some advantages, okay? So diversification is one of them, and dealing with high-level money managers as well, right? So this really, really qualified individuals are getting not only your money, but several individuals' funds putting it together. So now you're not as limited in terms of overall level of the portfolio, right? You can buy a diversified portfolio of stocks, right? You can buy stocks from different industries, because if one industry fails, then hopefully that industries won't fail as well, which will keep the level of value of of the portfolio still high. And that's a huge benefit, right? Imagine if you had to do that on your own. You're probably very limited on the diversification you can do if you want to buy stocks that are very expensive, right? The same with bonds. So they buy stocks and bonds, they have portfolio stocks and bonds, and then being in this mutual fund, you gain part of the returns of the mutual fund based on how much you put down. Okay. Financial intermediaries are really growing and have been growing for a long time, right? And that's no surprise. They are part of our lives more and more every day, and I think from the way it looks, they'll continue to be, right? Now, what are the reasons that they have been growing so much? One is technology. Look how much technology is part of our lives, and it's hard to deal with new technological tools, right? And banks create platforms which made them very user friendly for us, right? They're also creates new types of payment methods with later technology. So those debit and credit cards, right? Create secureness, create convenience, right? And in exchange, we do pay services and fees for those banks, but it has allowed them to grow a lot because technology has been a bigger and bigger part of society, especially with globalization, right? There's also economies of scale. Like I said, banks are really good at monitoring and screening individuals, especially because they have a really large data set with credit scores, right? They have experience with this because they do this all the time, and they can diversify their loans because they have a really pool of funds based on all the depositors they have, right? So once again, they can diversify, which is something that if you're trying to fund a loan by yourself, maybe you can only fund one loan, and if that person fails, you're done. Depending on whether that loan has a collateral or not, right? Something to back it up. But in the case of banks, they can diversify, and one person failing to pay their loan is not going to make them crash, right? Also secure. In a world full of uncertainty, knowing that you can leave your money somewhere without worrying that much, it helps, right? Once again, how many of us checked how our banks are doing on a daily basis? That's why they're growing so much, right? They don't really have that many challenges on our end to evaluate how they're doing. And the bigger banks keep getting bigger, and they keep getting even more economies of scale advantages, as we have mentioned before, and that allows them to grow more and more. And you can see that when you look into the graph on this figure 1, that shows the percent, the flow of funds, the percent of GDP that the financial sector consists in terms of its total assets. Okay, so as you can see, in the 1950s, about a little bit more than 100, maybe 30%, right, was the size of the financial sector relative to the size of the economy's GDP in the US. And now you can see that that's almost 500%, right? So that's crazy. It's a huge part of our economy, and that's why it's really important to understand. In the next video, we're going to talk about how financial intermediaries fail, and we'll keep going from there. Thanks for watching, guys.